today, since we've gotten a little preview about about your credit score and your credit history, right? As that helped to determine what interest rate you qualify for. We're going to talk more today in the 5.2 standard about your credit history and what goes into determining that credit score. All right. So let's get that set up. All right. So looking at credit scores and credit numbers, or the number, 3-digit number, okay, that kind of summarizes your credit history. Okay, so we're going to look at what is on in your credit history, in your credit report, and then how that impacts creating this number, this credit score. All right. So when you apply for a loan, whether that's a credit card or a home loan, a car loan, a personal loan, whatever, okay, the lender assesses you and tries to determine how worthy of credit you are, right? How trustworthy you are, how likely it is that you'll pay the loan back, if you're able to pay the loan back, and so on. All right. And so they use what's called the 4 C's of credit to determine your credit worthiness, right? How, what to rate what kind of credit customer you're likely to be. Okay. So each one of these characteristics starts with C. That's why it's called the 4 C's. And these are the things that are used to determine whether or not they're going to approve you for that loan. All right. So the first C is character. Now, when we talk about character, we're kind of talking about your reliability, your trustworthiness, your ethics, right? But it's really hard for a lender to gauge that and measure that in a really short amount of time. All right. And so in place of that, they use your credit score. Okay. So they're going to use your credit score as a way of measuring your reliability, your trustworthiness. Okay. They want to know, if we give you this money, right, how trustworthy are you to pay us back? Right. And the best predictor of future behavior is past behavior. So they're going to look at your past behavior in terms of how have you handled debt in the past? Have you paid off previous loans on time? Okay. Have you managed that well? And all of that is kind of encapsulated within the credit score. So later on, when we're talking about credit scores, okay, credit score only applies to this first C. It's a really important part of whether or not you get approved for a loan, but it's not the only thing that's considered or measured. All right. The second thing that's looked at is your capacity to pay that loan. Now, capacity just means ability. Okay. So here they're looking at your cash flow, meaning the money that you have coming in versus the money that you already are committed to spending going out. Okay. So if you already have a lot of debt that you have to pay, okay, whether that's in form of a mortgage, student loans, car loans, whatever, okay, if you already are committed to paying other bills and other debt, that's going to impact your cash flow. That's going to reduce the amount of available money that you have for a new loan. Okay? Or if your income is really low compared to the amount that you're trying to borrow, right, that's going to impact your ability to pay that loan back. Okay, so this just means your ability to pay it based on the income that's coming in and commitments that you already have for expenses going out. All right, the third C is capital. All right, capital refers to valuable things, valuable assets that you already own. Okay. And so things of value that you own is called equity. That's the value of those assets. So if you already own your home, or you've paid off a significant part of your home loan so that you own a large percentage of your home, right? If you've paid off your car and you own that, if you're a business and you fully own machinery and equipment or inventory, okay, these are all things of value that you could use to raise money if needed to pay off a loan. Okay, so again, this kind of relates to, have you been able to pay for large purchases in the past to own these? And then do you have things that you could sell to raise money to pay a loan if needed? All right, and then the fourth C is collateral. We talked about collateral yesterday. A collateral is something of value that you promise to give up if you don't fulfill the terms of that loan. Okay. Now, again, usually it's whatever the loan is being used to purchase. So if I'm taking out a mortgage, right, the house becomes the collateral. If I'm trying to get a car loan, the car becomes a collateral. But sometimes you might pledge something of value that's not why you're borrowing money, right? If you're taking out a business loan, for example, if you are an entrepreneur, if you're the sole proprietor, Okay, you might put your house up as collateral to get the business loan to open or expand a business. Okay, and so here again, the idea is that if you have something of your own that's at risk, okay, you're more likely to work hard to try to pay this loan off so that you don't lose that asset. Okay. From the lender's point of view, this helps to secure the loan because they're guaranteed something of value. So if they don't get money back for what they lend you, right, they'll get that item that they can turn around and sell to try to recoup that money. All right. So those are the 4 C's for a personal loan. If you're trying for a business loan, there's actually a 5th C called conditions. So business conditions, economic conditions. This looks at how is your individual business doing, okay, and how is the economy doing overall. Okay. So are you growing and you need to take out a business loan to expand? Right? You can't keep up with production because the demand for your products is so high. And so you want to take out a loan to buy new machines or to buy a larger, to rent out a larger warehouse, right? Whatever the case is. Okay. Or are you taking out a loan because you can't make your payments and you need to borrow money to make sure that you can pay off previous obligations? Okay. They'll also look at the economy as a whole. Is the economy growing? Are we in kind of an economic expansion or are we in a recession? Right? It was really hard to get a loan during the Great Depression. It was really hard to get a small business loan during the recession 10 years ago or 15 years ago now, right? In some cases, it was hard for a lot of businesses to get loans at the start of COVID, okay? Because we were seeing the economy really struggle during those times. Whereas when the economy is growing, when most individuals see an increase in their personal income, right? It's a little bit easier to get a business loan because when consumers have money to spend, they spend it generally. Okay, so we've got 4 C's for individual credit and a 5th C for business loans. Okay, and those make up the C's of credit. Now, as I said, character, right? Because lenders can't really quickly assess the borrower's character and their trustworthiness, they generally rely on how they've handled credit in the past, which is encapsulated with this credit score. All right, so we're going to talk about credit score more here. The first thing to understand about credit scores is that there's a bunch of different scoring models that exist, a bunch of different credit scores out there. All right. The most commonly used and referenced credit score is called a FICO score. So that's what we're going to talk about today. Just make sure that you understand that if if a website or if somebody is offering you a look at your credit score, hey, you want to make sure that you know what credit score they're giving you. Okay. And if you think that you're looking at a FICO score, but you're actually being given your Vantage score, right? That's something totally different with a different scoring method, with a different scoring range. So an 800 FICO score is going to mean something different than an 800 Vantage score, for example. Okay. So just make sure that you understand that there are different numbers out there. There are different scores out there. And what we're talking about today is a FICO score. Okay. Now, regardless of which number you're looking at or which credit score you're looking at, the basic premise behind them are all the same, right? It's a number that's generated from some mathematical equation or some statistical model to try to kind of burrow down all of your credit history into one number, okay? So that it's measurable and comparable and easy to understand. Okay, so rather than looking at 10 years worth of history, if I'm a lender and somebody comes to me to borrow money, right? Rather than trying to pour through 10 years of their history and every credit card that they've had and if they've made payments on time and who they've owed money to and how much and so on, right? All of that gets kind of summarized into this one single number that helps me gauge that very quickly at a moment's notice. Okay. Now, this credit score is really important in terms of contributing to whether or not you're approved or denied for a loan. But it's also important in terms of influencing what types of interest rates you're offered on your loans, but even beyond just credit. Okay. Landlords can look at your credit score to determine whether or not they approve you for an apartment. Okay. Insurance companies can look at this to determine and may give you discounts on insurance. Okay, if you have a really great credit history and good credit score, okay, if you've shown that you've been responsible with your credit, the idea is that you may be responsible for other things that you're trying to insure, like your property insurance, your car insurance, whatever. Okay, job employers can also check your credit score. In a recent survey, they found about 1 out of every 3 job applicants had their credit score examined when they're being considered for a job. Okay, particularly if the job has to do with the company's money. Okay, if you're going to be trusted with the company's money, many companies want to make sure that you've handled your own money responsibly. Right. So while this number is very important to whether or not you get approved or denied for loans and what interest rates you'll be charged, okay, it actually goes even beyond that. All right. So we said that the credit score we're going to look at today is a FICO score. So what is a FICO score? Well, a FICO score is this number that was developed by 3 credit bureaus. Okay, you can see on there, they're Experian, Equifax, and TransUnion. Okay, now make sure you understand a credit bureau and a credit union have very similar terms, but they are totally different. Okay, credit unions, we've talked about, that's a place where you can deposit money into various accounts. Credit bureaus are these organizations that collect information about your credit. Okay, so they will collect information on who you owe money to and how much you owe, and if you're making payments on time and what interest rates you're paying and other fees that you have paid, right? They collect all this information about your credit. All right, and they take all of that information and they put it into this software that generates this 3-digit number. Okay, now the software and the formula that's used, okay, was developed by the Fair Isaac Corporation. That's where FICO comes from, right? Fair Isaac Corporation turns into FICO. Okay, so they take all this information. In particular, they take 5 key elements and they put it into this mathematical formula. Now, this mathematical formula, statistical model, okay, is proprietary, meaning it's owned by them. It's not published anywhere. It's not public knowledge. Okay, but we still are able to, they still do make some features publicly known. And because of this, we can oftentimes at least estimate what our credit score would be, even without knowing the specifics. All right, so here are the 5 things that determine your credit score. Okay, number 1 is your payment history. So this looks at how well you've made your payments on credit on time. Okay, so how often do you make your payments on time? If you've been late, right? How long ago was it when you were late? Okay, being late 2 months ago is a lot different than missing a payment 5 years ago. Okay, so the more recent your late payment is, the more of an impact that it has. Okay, it also looks at how late were you? Were you 30 days late? Were you 60? Were you 90 days late? Okay. And then have you ever had any loans or any debt go into a public record by collections? Okay. Has it ever gone to collections where debt collectors are trying to collect? Have you ever had to declare bankruptcy? Okay, things like that would appear here as well. Now, this factor has the biggest impact on your score. It makes up more than 1/3 of your score. It makes up 35% of your overall credit score. Okay. The second biggest factor, the next biggest factor is how much you owe. Okay. And it's not just the raw number. Okay. It's not just the number of dollars that you owe, but it also looks at how much you owe relative to your overall credit limit. Okay. So it looks at how much of your credit have you used, and that's called your credit utilization. Okay. If you utilize something, you use it. So it's your credit usage. Okay. The percent of credit that you could use versus, or the percent that you have used versus how much you could use. All right. And so to calculate that credit utilization, you just take the current debt balance divided by your overall credit limit. Okay. In general, you want to try to keep this below 25%, but the lower the better, right? So if you can keep it at 15, even better. At 10, even better. All right. And this makes up 30% of your overall score. Okay, the third factor is the length of your credit history. Okay, so how long have you had credit? So it looks at when you opened up your very first credit account and then the average age of all of your credit accounts. If you have a longer credit history, okay, if you've managed credit for 15 years, right, that's more favorable than if you've only had credit for 2 months. Okay, so the longer the length of your credit history, the better that's going to help you out. Okay, this makes up 15% of your score. So right here, you should realize that when you first open a credit card or when you first apply for a loan, right, you don't have a credit history, or you might have very little credit history, you're already at a disadvantage a little bit by having a lower score because of this. All right. So young individuals, okay, who don't have much credit history are already at a little bit disadvantage because you haven't had time to generate all this history and to show that you're trustworthy. All right. The fourth factor is the amount of new credit that you have. So how many new applications have you made? How many new accounts have you opened? Okay. And it generally looks at the last 2 years. Okay. Well, there's a couple of measures. It looks at 6 months, 1 year, and up to 2 years. Okay. So anything within the last 2 years generally is considered new credit. Okay. So it looks at how many new applications have you had within that time? How many accounts have you opened during that time? And then how long has it been since your most recent account was opened? Okay. That makes up 10% of your score. And then the last factor is just the types of credit that you've used. Okay. The bigger mix of credit that you have, right, the more favorable that is. If you can show that you've handled installment loans and revolving loans and store credit and a home loan, a car loan, right? If you have all these different types of credits and you've handled it well, again, that will help demonstrate that you're trustworthy for whatever other loan you're trying to get. All right. So notice the things that weren't in here. There was nothing here about your job status. Okay. Whether you're employed, whether you're full-time, whether you're part-time, wasn't involved in these 5 factors. Okay. Whether you're married or whether you have kids, none of that is involved here. Okay. Now, it does impact your credit worthiness, right? The second C was capacity, your ability to pay. Now your income and your job status plays into that, right? But those types of things do not impact your credit score. Okay. So those are the things that go into generating your number. Now, what numbers are possible and what do those numbers mean? All right. FICO scores range from 300 up to 850, and the higher your score, the better. All right. And the average score is 704. And this was the first time that the average had ticked up above 700. This happened just a couple of years ago. Ever since the recession, 2008, 2009, okay, it's been slowly increasing over time as kind of families and our culture in general has emphasized trying to pay down your debt, trying to improve your savings a little bit over time. This number has been creeping up. At the time, when the recession hit in 2008, the average was about 675, 680. Okay. And so then over the last 10, 15 years, it's been growing by, a couple of points a year. All right. So what happens if you know your score and you're not happy with it, or even if you are satisfied with it, but you want to improve, right? What are some things that you can do to increase your score? Well, taking what those 5 factors are that go into determining your score, we can come up with kind of a game plan for how we can improve our score. All right. So number 1 is make sure that you're paying your bills on time every month. Okay. Even if you can only afford to make the minimum, at least make that minimum payment. Okay. Your payment history was that number 1 factor, is over a third of your score. Okay. So if you don't do anything else other than at least get your payments in on time every month, okay, that's going to help your score. If you miss a payment, okay, you have up to 30 days to get that in before it gets reported as late. So if you're a day or 2 days late, the individual loan will probably charge you a late fee. They may increase your interest rate on that one individual loan, but it won't get reported as late until it gets to 30 days. All right. Once you get to 30 days, then it gets reported as late. It gets reported again at 60 days and again at 90 days and again at 120 days. So if you haven't made a payment in 4 months, right, and you're 120 days late, that's gonna continue to get reported. All right. Now, late payments stay on your credit report for up to 7 years. So if you miss a payment today, it can impact you for almost the next decade. Now, the more time that you have since your last late payment, okay, the impact on that starts to diminish. So again, if you were late 6 years ago, that's going to have much less of an impact than if you were late 6 months ago. Okay, but it still nonetheless will impact your score. All right, so make sure you're paying your bills on time every month. Number 2, okay, try to pay down your current debt. So use a smaller percentage of your available credit. Right? Your credit utilization was the second largest factor. All right, so paying down your bills, right, lowering your credit usage, that percentage is going to help increase your score. Now, there's another option in terms of lowering your utilization, and that's to increase your credit limit, right? If your credit utilization is a fraction of the amounts owed over your credit limit, the way that you can reduce that percentage is either to lower your numerator or increase your denominator. Okay. The risky part, though, about increasing your credit limit is that if you're struggling with paying your bills and struggling with your own, kind of self-control over not spending what's available to you, increasing your credit limit could lead you to spend more on credit because you have more available to you. All right, which would be the exact opposite of what you want. Okay, so best case is that you're paying down the numerator, paying down what you owe, but in a pinch, if you need to increase your score by lowering your utilization, you may be able to increase your credit limits. And you can go back to your credit cards generally once every 6 months and ask them to reevaluate your credit limit and ask for an increase. Okay, so that always is a possibility. All right, number 3, dispute inaccuracies on your credit report. So inaccuracies, errors on your credit report aren't that uncommon. So you want to make sure that you get a copy of your credit report every year and look it over. Okay. There are 2 websites where you can always get a copy of your credit report for free once a year. And that's myfico.com and annualcreditreport.com. Okay. And you actually can get a free credit report from each of the 3 credit bureaus. So you could get all 3 of them at once. You can get TransUnion, Equifax, Experian credit reports all at once. You could spread it out if you want. Right? You get one in January, one in May, one in August, and then start that cycle over the next year. Okay. But you can get one free credit report from each of the credit bureaus once per year. And actually, they changed this when COVID hit. They changed it to you could get it once a month temporarily. Okay. But that's now since gone back to once a year. There are other sites that offer free credit reports and free credit scores. Oftentimes, it requires a purchase first to qualify for that free. So even though the credit report itself or the credit score might be free, you have to make a purchase to qualify for it. So it's not entirely free. The other thing is it might not be your FICO score, right? It might be some other credit score. And if you're trying to track your FICO score, then that's not going to be necessarily all that helpful. Okay. Number 4, avoid applying for numerous new credit lines in a short period of time. So I live down near Iowa City. If I went to the Coralville Mall, right, or Coral Ridge Mall, and I started at one end of that mall, right? If you've ever been there, right, at one end, you've got like Best Buy and Target. I could go in and each of those have their own store credit, right? I could go in and apply for that. And then as I walk down the mall, I'd probably run into 20 other stores where if I stopped in, they always say when you're checking out, would you like to apply for the Shields store card or the Barnes and Noble credit card, right? If you qualify, we'll give you 30% off your purchase today. Okay, so if I went into those stores and every store that I stopped at, they offered me that and I applied it to every one of those, right? All of a sudden, I'm walking out of that mall at the end of the day with 10 or 15 more credit cards. Okay, so that's going to impact me quite negatively in that the 4th factor, right, is the amount of new credit you have, the number of new applications and accounts that you've opened in the last 2 years. Okay, so every time that you apply for a new credit card or every time you apply for a loan, that goes on your credit report and impacts your credit score. Now, there's 2 types of loans where this is a little bit different, and that's home loans and car loans. Okay, if I'm in the market for a new house, right, and I need to take out a home loan, if I go to a bank and a credit union and an online lender, right, I might get 3 different home loan offers. All of those are going to count just as one application. Okay, it's called an inquiry. The reason is they know that I haven't applied for a home loan at those 3 different locations because I'm actually buying 3 homes, right? I just want to comparison shop what I would qualify for. Same thing with a car loan. Okay, if I go to dealership 1, dealership 2, my credit union, an online lender, right? They know that I'm not doing that because I plan on buying 4 cars. It's just because I want to see what I would qualify for at each place. So you do have some protections for home loans and car loans within about a 2-week time frame or a 3-week time frame, and that each one of those only count as one total inquiry. But if I apply for, let's say, a home loan today, I end up not buying a house. 2 months later, I apply again to see what I would qualify for. That is going to count as a second inquiry. Okay. So again, just know that. But any kind of personal loan or line of credit, credit cards, things like that, every single one counts as an inquiry. And then the last tip here is a little bit counterintuitive. Okay? And this is don't close credit accounts that you don't use. All right. And so I'll try to walk you through why this makes sense when you think about it kind of in an odd way. So let's say that I've got 4 credit cards. Okay. And on 3 of those credit cards, I have a balance, and the 4th one I never use. Okay. I might try for simplicity to try to get things in order. I look at this and I say, well, I'm not using this last credit card. I'm going to cancel it. All right. Now let's say each credit card has, just for simplicity, a $1,000 credit limit. Overall, my credit limit is $4,000. Okay. And let's say on the 3 cards that I do have a balance on, I owe $1,000. So overall, my amount of credit used is 1,000. My credit limit is 4,000. 1,000 over 4,000 means my utilization is 25%. If I cancel that last card, right, I never use it, I don't owe any balance on it, I still owe $1,000 on the other 3 cards. But I have now removed the credit limit from the equation of that 4th card. So now I'm using $1,000 of 3,000 total credit limit. So by trying to have simplicity and trying to kind of get things organized by canceling that card, I've kept my balance the same, but I've reduced the denominator in that fraction, and it now appears like I'm using more credit. Okay. My credit utilization goes up to 33%. All of a sudden, when it goes into that mathematical equation, right? There's no value judgment in that. It's just numbers that go in to get a number coming out. So there's no way to explain to that no, I'm not using extra credit. I just wanted to cancel a card I didn't use. Okay, so when you close that account, you remove the credit limit, but you maintain the same balance. So your credit utilization goes up, which can have a negative impact on your score, and your score can actually go down. Okay, now there is one exception to this. Okay, so there is one time where even though your utilization will go up and your score may go down, okay, the exception to this is if your unused card charges you an annual fee. Cancel the card. Okay, do not pay an annual fee to keep open an account or keep open a card that you don't use. Yes, your credit utilization will go up. Yes, your score might temporarily go down. Okay, but you can always build your score back up. Okay, by paying down those debts, in the coming months, making sure that you're still paying on time every month. You'll be able to demonstrate your trustworthiness, your creditworthiness, and increase your score over time. But you'll never get back the cost of that annual fee, especially for a card that you don't use. Okay, so the savings of the annual fee will more than make up for the ding to your credit score, and you'll always be able to repair that credit score and get it back up. All right, that makes sense? Okay, there are, if you're so inclined, there's a couple of videos on here that you can watch if you would like to. Okay, I'm not going to show them right now. Instead, I'm going to jump ahead to your worksheets for the day. Okay, so on the 5.2 page, there is this 5.2 determining your score and 5.2 impact of your score. You need to make sure that you do these in order, all right? Because the information that you get from the first worksheet will be used on the second worksheet. So I'm going to show you really quick what each of these look like. All right. So again, it's got a breakdown of what your FICO score factors are at the top here. And then it walks through 3 individuals and what their credit, kind of a snapshot of their credit situation. So you've got Sam Spendthrift, you've got Jessica Credit Smart, you've got Daniel Debt Free. Right? There's a link here to a FICO score estimator. All right. So again, we don't know what the exact mathematical equation is, but we can estimate it and get a range of what your score would likely to be. Okay. And so what you'll need to do is input for each of these scenarios, input this information. All right. And then see what it gives you as the likely score range that each would have. Okay. So like Sam says currently 3 credit cards. So I would say he's between 2 and 4. Okay. He got his first card 8 months ago. So between 6 months and 2 years. Okay. So again, it's going to walk you through, and I think I've got these in order of the questions that the estimator asks. So you should be able to go just straight down the line. All right. Then you take a guess as to what you think their score is, go through the estimator, see what the estimator says their score is likely to be, and then what does that number say about their credit worthiness. All right. And you'll do that for all 3 individuals. Then on the second worksheet, you're going to take that information, move that over here for their score, and then you're going to use another payment calculator. This one looks at not credit cards, but other types of loans. Okay. And so you're going to look at a car loan, and then on the second page, a home loan, based on what and determine what kinds of loans they would qualify for, what interest rate they would qualify for, and so on, based on their credit score. All right. Make sure that, especially on the second worksheet, make sure that you read the instructions, because moving the scores over from the first worksheet to the second, okay, gives you a range. That first worksheet will give you a range of possible scores. Okay, so make sure you read the instructions so you know which number within that range to select. All right. And so that's what you've got to accomplish today. We'll go over these tomorrow, and then we'll look at tomorrow's strategies of paying down your debt. All right. So let me know if you have any questions. Otherwise, get to work.